And there might be a bit of a delay at the end, man. Sometimes it takes me a while to end it. You're always trying to find the end button. You get that awkward 10 seconds of silence.
Yeah, that's all right. All
good. How'd your deck go? How's the deck going?
Still going. I've got a lot of it done. But yeah, a lot of it's not too bad. It's coming up pretty good actually. Yeah. Once I've got it done, I'll send you some photos.
Cool. Mate, we're going, we're live. Okay. I'm trying to multitask. We're going live. So hey guys, girls, hope everyone's had a great week so far. Happy Thursday. Tony and I have just been chatting in the background, just getting ready for today's live coaching call. We'll hit the ground running pretty soon. We'll give you guys an extra 30 seconds. Hey, Chris, how are you? If you're watching, guys, just say hello so we know we're not talking to ourselves. Give us a like or give us a hi, a hello. How are you, Chris? How's your week? Hey, Hoppy from WA, Michael Hopkinson from WA, Jeff from Armidale, down your way, Tony.
Yeah, New England.
Hey, Jeff. So what we're covering today, guys and girls, is pros and cons of different types of structures in business. And on the back end of the last masterclass we did, it was the 26th of March, mate. It's almost two months ago, buddy.
Yeah, wow.
I had a lot of questions, a lot of comments in the Q&A about different structures.
Yep.
Sole trader, partnership company in particular. So that's why I thought it was appropriate that we start with this one and go from there. So I'm going to keep it short and sweet, guys, because I know you guys are busy and probably got better things to do than listen to Tony and I rabble on. But let's get started, Tony. So if you don't know already, you haven't met Tony. Tony and I have been working together. I did the numbers the other day, mate. It's the best part of 2 decades, almost 2 decades.
Yeah, my eldest is 17, so I think we met about that time, about 18 years.
18 years, yep. 18 years ago. So Tony and I have been working together for a very, very long time, much more intimately in business in the last decade, in particular with the business, not just doing our compliance stuff. And the reason why, one of the reasons why I like having Tony on these calls, one, he's a good bloke and a good mate, but he has a very intimate knowledge specifically about painting businesses, which is very appropriate, I feel, for our community and us painters out there. I just saw Brett just cross my path, but Brett, if you're there, say hello. Hey, Steve, say hello. Anyone watching, say hello. So do you want to say hello, Tony?
Yeah. Thanks, Taz. Thanks for the comments and praise. Thank you. Mate, yeah, same goes with you. You're a champion bloke, and it's always a pleasure to be working with business clients like yourself and form friendships over the years. And it's been good to deal with someone who's really proactive in their business and their industry. So well done to get this thing off the ground as well with Taz Moulis as the coach and the mentor and mediator to a lot of businesses out there in the painting industry. So well done.
Thanks, buddy.
Guys, look, the main thing, I suppose, just a bit of background on me. I'm a CPA bean counter accountant. Obviously the CPA piece is the professional qualifications, and my years of experience dealing with small business, obviously extends even pre-Taz. I've been around a few years. One of the things that we do as accountants is we actually look at structuring as a key thing for businesses, and just not necessarily on tax minimisation, but a lot to do with asset protection as a key part. So what I wanted to just talk to through today is 4 key structures that Taz has alluded to, and just make sure that I do a sort of high level review of this. This rundown I'm going to give is not a one size fits all. Structuring is quite complex, so I'm not taking into consideration anyone's individual circumstances, but I am taking it on a basic consideration of business and business clients, and in general, painting clients and trade-based businesses and how they sort of fit within structuring. So I'll just get into the pros and cons of each, if you're okay with that, Taz.
Yeah, mate, go for it, Tony.
Yep. So the one structure that most businesses start off with, and possibly some of you guys have done this, and like I like to say is with structuring is it's like a 5-year time frame. You can sort of go through one period of structuring, then you have to restructure, and that's even if you are in a company or trust, just because compliance changes and your assets within the business and outside change. So restructuring always is something that needs to be thought about and considered with your accountant. But where most people do start is off as a sole trader. So that arrangement where you can just get an ABN and you can start trading, with a bank account. You might, obviously start even not necessarily to have your accounts in Xero or Mob. You might even just have them in a spreadsheet or whatever the case may be. These types of structures are very cheap to establish.
Yep.
So, basically you can start, today with an ABN, and you can start trading today or tomorrow. Now, they are also good, I suppose, as far as where people are starting out and they may have sort of crossed over in 1 year with a wage income or whatever else, and the business may not be going that well to start with because, obviously you've got to build it up. So with a sole trader, tax losses that are generated within that trust, within that arrangement as a sole trader, can be offset against your other income as long as you meet certain tests. One test is really what's called a non-commercial loss rule. But I won't go into detail there, but there are plenty of opportunities to offset your losses as a sole trader, and that's an advantage. The other main advantage with a sole trader is capital gains tax. So as a capital gains tax concessions for an individual, you've got a 50% discount on a capital gain for an asset you've held for more than 12 months. So that normally applies with most people. They think about property or shares and the likes. That also does apply to businesses when you sell the business. There are other business-related concessions, which are called small business concessions, capital gains concessions. They're a bit more tricky and a bit more complex, but I'd imagine that most people on the call here would have access to those. But when considering to sell the business or looking to restructure, those sorts of things come into play and are of consideration. So for a sole trader, they're all pretty positive outcomes. On the negative side of things, the sole trader doesn't allow you to split the income. So whatever's earned within that sole trader is in your tax return, and you pay tax on that profit. Plus it's added to your other income that you may have earned in that year, in that financial year. So there's no opportunity really to stream income to your spouses or etc. They can still employ, obviously, but they are challenging for splitting income. Probably the main disadvantage is asset protection. So as a sole trader, what's that, Taz?
Sorry, Tony, that's the first one that came to mind. No asset protection.
Yeah, it's a big one, and people probably overlook it. And this is why it's important to restructure, because if you're a young guy that's going out into business, maybe you don't have much to protect. So, you're trading, effectively starting to build some assets up, whether that be a family home or whatever the case may be. But whatever you're in business, you've got a lot of risks. You've got risks from creditors, you've got risks from customers, you got, you know, there's risk from everywhere that can really have an impact on your business if things don't go that well. And especially at the moment with COVID, if people are feeling the pinch, and asset protection is a big thing that's coming up as a concern. So for a sole trader, it doesn't offer any asset protection. So whatever you've got in your name as assets can be accessible by a creditor, etc. So that's a big one.
Yeah.
The other disadvantage is individual tax rates. So as a business sort of starts to generate more income and you start to exceed the 30% tax bracket because of marginal tax rates, you lose some of the advantages of, say, what a company would provide. It doesn't cap your tax off. So that can be challenging for tax planning, because what you've got is that, you know, from year to year, unless you're really over your numbers, you might get this big surprise at the end of the year when you lodge your tax return that profit was quite good, and you haven't been able to cap the tax off, and then therefore having to pay a higher tax rate than you probably would have otherwise, have you restructured into a company or something similar.
Yeah.
So Taz, that's it for really sole traders as we stand. If you're happy, I can move on to the next part.
Yeah, move to the next one, mate. Yeah, I think everyone's got an understanding of sole trader, and you know, it's easy to set up, easy to start, but the risks, there's a lot more risk involved.
Yeah.
So when you're starting out, potentially don't have assets, and you don't really much, you know, much liabilities involved, might be okay, but that's only when you're starting out. Eventually, you want to transition to somewhere you're going to get some asset protection and some benefits from being able to cap the tax rate.
That's right. Yeah. So that's a good summary, and that's what most people do, is that they start to look at restructuring into companies and trusts. We have got partnerships on the list, and I'll quickly talk to that. I mean, it does has. What's that, Taz?
No, I said all good, mate.
The partnership arrangements, we see less and less of these. You know, we probably would never, I haven't advised a person to sort of go into a partnership unless they've come to me specifically asking that, but I haven't sort of set up a partnership as such for probably over a decade. So these types of arrangements becoming less and less common. But we have these things called a common law partnership, where most people just sort of set up a partnership with an ABN, and it's a 50-50 split. You know, the ATO and the legal, etc., would prefer an agreement in place as a partnership, and you can sort of then sort of adjust your percentages if you've got an agreement. But if you don't, it's just a 50-50 arrangement. On the positive side. On the positive side, they are cheap to establish. Pretty much an ABN again, bank account, set up a Xero file or whatever for your bookkeeping, and you're pretty well on your way, making sure you get your insurances, etc. There's some ability to split income. Obviously, with your partner, you've got a 50-50 split, so it's a little bit more than a partnership. The tax losses that may come about from a partnership can flow through to the individual partners. So there is that benefit. But like I said, they're not common anymore, and they don't provide any asset protection. So similar to a sole trader. And you also have that individual tax rate issue that, you know, if there is a high tax rate, taxable income for the year, that you don't have that ability to cap it off. So there are some other higher level partnerships that I won't go into today, like partnerships of discretionary trusts and the likes.
Yep.
So there are some scope for partnerships, but at the individual level, they're a little bit difficult.
All right, mate. Just if you don't mind, we'll pause for like 30 seconds.
Sure.
Just so everyone can take that in. Anyone got any questions? You want to chuck in the comments, guys? I'm wary of time, and we're going to punch punch through this as fast as we can. But I think, in essence, correct me if I'm wrong, Tony, pretty much these structures split up into two big categories. You have the sole trading partnership in one category, and then the company trust structures in another category.
Yeah. The company trust structures, they're a little bit more complex and a little bit more expensive, etc. And but, if there aren't any questions, I can step you through those.
Mate, let's get rocking and rolling. I'll check out the comments for any questions and get back to you. Let's go.
Okay, cool. The first main one that people consider is a company structure. So companies in Australia are known as proprietary limited companies, PTY Ltd. You would see after the name. What that basically means, and there are other companies, there are limited companies, publicly listed companies, etc. But what we're dealing with today is a proprietary limited. Proprietary limited is private, so shareholders of no more than 20, and limited by the assets held within that company. That's the beauty of Australian company law, in that there are moves, obviously, to try and remove the limited and bring directors into play more and more. But that ability to have it limited and set it as a separate legal entity is very good for asset protection, and very good for businesses to take risk on, to make sure that if the business does fall over, the company falls over, that the exposure is limited to that company. So they're very good for that. So the positives from company is effectively the tax rate. So there has been a move in the last few years to move it, tax rate from 30% down to 28.5%, now to 27.5%. So currently it sits at 27.5%. There are potential moves to bring that tax rate down in future years as well. It will be interesting to see how the budget comes out in October, which would normally be in May, but it's now going to be pushed back till October to see what they do with company tax rates. But where we sit at the moment, a trading entity, so a painting type business that trades under a proprietary limited company, tax rates capped at 27.5%. A non-trading entity that might be a company, it's still set up as a company, that may, for example, be a company set up to buy a property.
Like holding asset, for example?
Yeah, might hold
asset.
Yep. And you may not have much trading in there. It's not a base, what we call base rate type company. That company tax rate's at 30%. So it's somewhere between 27.5% and 30%. Your companies are capped at. So that's a great thing to know that whatever the profits are, you're going to be taxed at that rate. The other thing is with asset protection. So this is where I've just talked to the limited liability for asset, that the assets within that company is where the limitation of claim is in the most, so against creditors. So that's a real important part to why people go into companies, that they want to limit their exposure. So they're the two things that are mainly used now as an advantage. Now the disadvantages, there's a few, and I'll just quickly go through those. The main thing, I suppose, with tax losses that may have been allowed to be able to offset other income within a sole trader, you don't have that ability in a company. You can't stream that tax loss out. It is contained within that business structure, within that legal entity, which is a company, and it is carried forward. So there are some complexities there as well on continuation of ownership and same business tests that come into play. But in the most, that'd only come into play if you're going to acquire a company, and whether you wanted to use those losses, sometimes you can have a bit of an issue there. But all in all, most businesses that are trading within the one structure year to year, losses carried forward will just accumulate, and hopefully they act as a future tax benefit that when you start to make a profit. The other thing is that they're probably a little bit more expensive to establish, and the ongoing costs as well. So you've got to establish the company, which requires ASIC fees. There's a bit involved for yourself to get that set up, and I always encourage you to utilise your accountant to do that, just for the sake of minimising your risk of getting it wrong. You want to make sure that your share structure is right. You've considered all options. You want to consider who should be the appropriate director. You want to make sure that your share certificates and all your other ASIC lodgements are all done appropriately. Your ATA lodgements and everything else are done in line with that company as well. The other expensive part with the company is the annual fees. So you've got an annual ASIC fee. ASIC is the Australian Securities Investment Commission, which is the corporate watchdog that manages companies, the regulator for companies. And so you have to pay them an annual fee. And then you also have to pay for a set of financial statements and tax returns to be done independent of the individuals. So it has its own set of financial statements and tax return has to be done. Again, you'd be talking to your accountant on that. The other downside there, Taz, the main one is CGT. There's no concessions effectively or discounts. So the capital gain on a sale of an asset, maybe it's the sale of the business, doesn't provide you much as far as of concessions to discount that capital gain. So, for example, if you had a business that you sold for $200,000 and say it cost you $50,000 to set it up, that difference of $150,000 is taxed at the company tax rate of 27.5%. Whereas if that same arrangement was sold out via a individual partnership, and what I'll talk to next, the trust, is that you can access these concessions which discount that capital gain by at least half, and in some cases even more, down to zero, because of small business CGT concessions, which are a little bit more complex, but I won't talk to. But in the most, companies don't provide too much in the way of CGT concessions.
Yeah. Cool, mate. Thank you. No, thank Craig. How are you? Anthony, no problem, buddy. It's going to be in here for a while. Sorry, mate, a couple of questions. Tony. So should we pump into the last one? Trusts, discretionary trusts.
Yep, no worries. So I'm just going to talk to discretionary trusts. So there are other trusts, and probably the easiest way to talk to discretionary trusts is that they're non-fixed, that they're at the discretion of what we call the trustee, or the person that is the representative for the trust, to flow distributions through to beneficiaries, and they're not fixed. Whereas a unit trust is a fixed entitlement, and there are things like hybrid trusts as well, which is a mixture of both. But we're just going to talk to discretionary, which is flexibility. So family trust or a discretionary trust, that requires a trustee. So they have to be started with that. And also there's a few different roles in that. So to start a trust, you need a settler to basically give you a $10 check or a $5 check to start it off with, and then you're off and running. The benefits of a trust is obviously this income splitting. So the ability to flow distributions through to individuals or companies effectively. So why you would do that is to better manage your tax outcomes. So trusts are great for managing tax. So you may be going into a trust, a restructure, or even starting that way for that purpose of well, I've got my wife or husband or even some adults that you can stream income to that may have a low income, and you're looking there to try and maximise that opportunity to reduce your tax. But you can also have a company as a beneficiary of that trust. So that then caps your tax off at 30%. Now, the reason I say 30% because you normally send the distribution to a company that is non-trading, where I talked about before, a trading entity is at 27.5%, a non-trading company beneficiary be taxed at 30%. But it still has that ability to sort of cap your tax off at 30%. The other benefits of trusts, it does have access to the small business CGT concessions, and that, although that the trust itself, and this is an important point, sorry, I'll go back to tax, is that the trust itself doesn't pay tax, it flows through. So when you lodge a tax return for a trust, it won't have a tax liability. It can if it doesn't have a resolution to distribute to anyone, but it's taxed at the highest tax rate if you do that, and no one does that. So they basically flow it through to beneficiaries, and it doesn't have a tax to pay. It still has to lodge a tax return, but it doesn't have tax to pay. Now, where it comes in with capital gains tax is that it still has to have a capital gain effectively to stream through to the beneficiaries, but those beneficiaries being individuals, normally, this is why you'd only stream capital gains through to individuals, is that they have the ability to access these concessions starting at the 50% discount for an asset that's held more than 12 months. You normally wouldn't distribute a capital gain from a trust to a company because the company doesn't have access to those concessions. So that's an important point to remember if you're doing that. Normally, this is why you'd only stream capital gains. Is that a bit of feedback, Taz?
That was me, mate. Sorry, me playing around in the background.
Oh, right, no worries. The only other thing that to make sure in a prudent approach, I'd like to say with regards to trust, is that you do have a few different parties to it, and what we've got a thing called a settler, which starts the trust. We've got a trustee, which basically manages the trust. We've got beneficiaries, which I've talked about, and we've got a thing called an appointor as well, which I won't talk too much with that, but it is an important role. The main thing there, I suppose, I wanted to talk to is a trustee, and then what you would normally do as a legal representative of the trust is that you would normally have a trustee being a company. So you'd have XYZ Proprietary Limited as the trustee for the trust. For again, the purpose of asset protection, that the legal person or the legal entity that signs off with supplier invoices, with customers, etc., is not so much the trust, it's the trustee. So if you're, Roger Rabbit and you're a trustee of that trust, you're going to sign off as Roger Rabbit on everything. It'd be best to have XYZ Proprietary Limited as a trustee, just to limit your exposure there. So they're very good, they're very flexible, and great opportunities there present with that flexibility. On the downside, they're a little bit more complex. There are a few more moving parts to this, as I was explaining the different roles. And sometimes it does take a bit of a journey for people to get their heads around trust structures and what they can and can't do with them. It's important that you have a good advisor in that space to explain these things to you on if you're going to go down that road. They're more expensive.
Tony, I think it took me 12 months to get my head around it. 10, obviously 15 years ago, but it is. And if we haven't said already, guys and girls, just make sure you talk to your financial advisor, your accountant, and your legal advisors, because getting into companies and trust structures and corporate trustees and directors and appointers and trustees and corporate trustees is complicated. So Tony and I are covering it. Tony mainly is covering it pretty quickly, but just be mindful that what we're talking about is very high level stuff, and you want to talk about your individual circumstances and go talk to your nominated, trusted advisors. So, sorry, Tony, just want to jump in there.
No, that's important. Thanks, Taz. together with the complexities, obviously more expense. So there's the establishment of the trustee, and potentially if you're going to have a company as trustee, there's that cost. Then you've also got the annual compliance costs, which would include a separate tax return and a set of financial statements. You've also got to have a trust resolution done before the end of June each year to nominate who the beneficiaries are going to be in receipt of the income for the year. So there's a little bit more cost-wise, complexity, and then also tax losses. So talking to the tax loss situation that we've talked to in the other entities, that the tax loss is the same as a company in that it has to be contained within that trust, and it can't be streamed through to individuals. So if you're, for example, you're operating via a trust and you're paying yourself a wage, and you may pay yourself a good wage over a tax rate, and say you pay yourself $100,000 a year, and you are then the business itself has got a loss through a trust, and you're thinking, well, I want to use that loss to offset it against my other income that I'm paying tax on in my wages. Well, you can't strip that loss out and offset it against the wage income. The loss is contained within the trust and it gets rolled forward. So that's the only other thing to probably just be mindful of as a downside with dealing with trusts. So Taz, that's pretty much it in a nutshell on those four structures. I won't talk to any other complex types of arrangements, but that sort of covers off in general terms those four.
Thanks, Tony. Yeah, mate, we covered a lot in a short period of time, and we've gone over time, so sorry, everybody. But thanks again, Tony, for your time. Really appreciate you doing this. I know you and I got a meeting straight after this anyway. We were talking about my situation. And I just, listen, there's one thing I want to mention. If you guys should be talking to your financial advisors regularly, you may not have to do it as often as Tony and I speak, twice a month, but at least, monthly, just to see where everything's going for you. And especially this time of year, Tony, we were just talking before we jumped on this call. This is the busiest time for you guys, isn't it? May, June, end of financial year. And typically, well, you tell me what tradies do this time of year, Tony. I can only hazard a guess. You tell me what typically happens.
Look, typically what happens is that there might be equipment that's being purchased. Just that normally is something that's highlighted by tradies, is that they go, well, look, I want to buy a new truck or a piece of equipment. Without any real consideration of the tax implications. It is important to make sure that you tax plan out. So having a forecast based on the numbers to date and what you're looking like to be tax-wise if you continually trade the way that you have been up until the end of June, it's important to have a number there and then make some decisions. Is it worthwhile purchasing something, or, paying wages, bonuses, superannuation, all the sorts of things that come along with consideration of management of tax before the 30th of June. Because once 30th of June crosses over, that opportunity to minimise your tax and manage your tax is gone.
Yep. All right, playing around again. I'm testing out my new iPad, peeps. I got one question from Stephen. He's asked, if you have a trust paying a company, does that company then pay you? I suppose it depends.
Yeah, it just depends on how you've got the company structured. So if the trust is paying through to the company, I take it can pay the company in two ways. It can pay the company as a beneficiary, or it can pay the company for services rendered as another supplier. So let's say it's paid as a distribution, which would be mainly the case, a trust paying to a company as a beneficiary. That company would pay tax rate of, for example, 30%. To get that money out of that company, we then look at the share structure. So the shareholding of that company would determine how we stream that income back out of the company. What happens with the distributions from a company, normally we have this thing called franking credits. So that's tax that's been paid already on the profits.
Yep.
And those credits would flow through to the shareholder. And And depending on who the shareholder is, if it's the individuals, you wouldn't have to pay 30% of the profit of what you've received from the company. You only have to pay what's called a top-up tax, which is your marginal tax rate less the credits. So if I'm answering that, Stephen, for you correctly, that's how it sort of works. But it might just need a bit of mapping out for you with your accountant, or so to speak, to try and work out if that's the arrangement.
Cool. Thanks again, Tony. Going to
Cool.
sign off because we've gone over almost 15 minutes, and we're going to chat real soon anyway. Thanks everyone for joining today. Really appreciate you taking the time out of your day to have a listen. We're going to be catching up in a fortnight. If anyone's got any pressing questions in regards to the accounting, the business side of your painting business, chuck them in the comments below. We've already got a topic picked for next week, but we've got enough interest and enough similar questions. I know next week's topic is going to be around answering the number one question or problem that Tony sees in trade businesses every year. But if anyone's got any other pressing issues that they have, pump them in the comment section, and we'll see what the most popular one is. So thanks again, everybody. Have a great rest of the day and finish off the week. Thanks, guys.
Thanks, guys.
I'll see you soon, Tony.